What's up, Resource Nation? Welcome to another edition of the Masterclass series, and I'm really excited because all the way from New York, we got our HousingWire CEO and President, Clayton Collins, which, if you guys, I'm sure you know HousingWire because it's, in my opinion, one of the best real estate mortgage news outlets in the entire nation. So I'm really excited to have President and CEO. He's also has a really cool, I don't know if it's necessarily new, I think you're in season 2 Housing News podcast. If you haven't listened to that, he's got really high level talent. I just listened to the Bill Dallas interview. That was about 45 minutes, and I really liked it. So check that out. Also, HousingWire and Clayton have 2 big events coming up. Engage Marketing in Orange County. I think that's in June 2020. Engage Talent in Dallas, and I think that's February 20th. Did I get that right?
You got it. February 6th. We're just 3 weeks away from Engage Talent.
Clayton, man, welcome to the show. It's awesome to have you on, all the way from New York City too, right?
Yeah, well, I'm in New York today. We're actually based in Dallas. So our headquarters is in Dallas. Our whole team is out in Las Colinas. And it's an awesome place to live and run a business. We are a media company, so we have hired a few great people in New York. So we have 2 team based here in the city, and so I'm up here in New York today at their office, and timing worked out well to hop on and join you for this episode.
You know, I want to dig in because there's so much to learn from your story, and I want to kind of ask you about that story here in a minute. But I mean, you have done a really good job building a really successful brand, and I think realtors, lenders, really any entrepreneur or small business owner can learn a lot from your story. And so I want to get into that. I mean, I think I read that you guys had 7.5 million readers last year.
Yeah, we surpassed 7.5 million uniques. So we're touching a lot of people.
And you've only been there 4 years. So talk to us about that story, man. 7.5 million readers, unique, and then 4 years, national brand. It seems like you guys are adding talent every day, new contributors, like It's a really successful story, and I'm really curious how you got there so quickly, in my opinion. And maybe it doesn't seem that quick for you, but outside looking in, it seems like a really cool success story that happened almost overnight.
Yeah, I mean, I think like anything, nothing happens overnight. It's been a lot of years and hard work to kind of get to this place, and it still feels like we are very early in our story and have big ambitious things to accomplish in the coming years. So this isn't a celebratory lap quite yet. We are we're still building and growing. But so my story, I didn't found HousingWire. So HousingWire was actually founded in 2008.
Right.
The founders ran a very successful business that became a leading brand and reputable source of news and information for mortgage professionals. And I came into the picture in 2016, and I led an investor group to acquire the company with the goal and intent of stepping into an operating seat and helping the founders transition out to move on to their next adventure. And my background is coming from the banking world. So I started my career at Citigroup in New York. I was in a leadership development program, did a lot of different roles across Citi's retail bank and credit cards and small business banking. I led a branch in Manhattan during the financial crisis, which was a crazy time.
Fun time, right?
A very early career manager, let alone like just really early in my career to be managing 25 people at 5th and 37th in Manhattan.
Oh, geez, yeah.
Late 2008 when Citi was going through some tough times.
How do you get from there? Because I remember reading that. I mean, we were at Citibank, small title called VP of National Sales and Marketing, if I remember right. And then, like, did you always have a desire to get into media? Like, that seems like obviously it's in the same industry, but it's 2 different, apples and oranges.
No, at that point in my career, I wasn't thinking of media. It, like, kind of a confluence of events led to this place. So after a few years at Citi, I went back to business school and went down the investment banking path and joined Royal Bank of Canada, RBC Capital Markets, and their generalist M&A group. And I built a strong bond and fell in with a group of guys who were doing a lot of digital media transactions. So we ended up working for a few large multinational media companies and doing a lot of sell-side deals of non-core digital assets. So I was working with these operators and general managers of these small, mid-sized digital media companies and through sell side transactions, and a few of them you may be familiar with, not huge names, but petfinder.com, the largest pet adoption site, How Stuff Works, which is an amazing source of information on how stuff works. So it helped lead those sell side deals. And I'm kind of you work shoulder to shoulder with these operators. And as a banker, it's really interesting to get to see so many different companies. But once a deal closes, you kind of wash your hands, step away, and don't get to see what happens on the other side. And I was really interested in what happened on the other side. What happens after a deal? Like how all these plans and stories that we've been helping the company tell and communicate. Like I don't know how that plays out. Like I don't know what the financial performance looks like 3 or 4 years down the road, or what happens to the people or the product. And I was really interested in seeing it through. So I made the decision to leave RBC and raise a small fund with a group of investors that kind of saw my vision in finding a company to acquire and personally operate. And that path led me to HousingWire.
Nice. So that makes sense. Kind of hearing that we do research, and you can kind of see LinkedIn profiles and other things and see how people move around, but you don't really know the story behind it. So that makes sense now, kind of reading and looking into your background. Talk about so now you're there at HousingWire. I don't know how familiar or comfortable you are in this new role. You got people to manage. It's different than capital. Was there strategy? Because I think the strategy that I've seen out, third party looking in, adding the contributors and the influencers is brilliant. We talked about a book last week called The Hitmakers. It's a page right out of that book. And you've done that successfully. Was that like plan on day one, getting ultra honest and vulnerable, or is that something you kind of fell into?
No, so one of the things we liked about HousingWire was from the day it was founded, the mission was to connect the real estate, mortgage origination, secondary markets, and servicing worlds. And the view was that a lot of the factors that led to 2008 and led to the housing crisis were a lack of information transparency between the different professionals and constituents in the industry. So the real estate agent and broker world didn't know the challenges that originators were facing. The servicing world didn't know the quality of loans that were coming out of the origination channel. Secondary markets didn't see any of this until later. And our goal, and the HousingWire's goal, was to serve all of those audiences and keep everybody informed on the entire housing economy. So at the time, we were taking a unique view in covering the whole housing economy versus like that really narrow, like job title specific information that you often find in business to business or trade media. And that was a really attractive part of the company, not just because they served a larger audience, because it was a mission that I could get behind. Right. I saw a lot of the turmoil that came from the housing crisis while I was at Citi. So when we came into the business, the first and foremost, we had a successful growing business, and the mission is don't screw it up. Like that's all like keep the train on the tracks, support the team, recognize that we have great journalists and great media salespeople and great technologists and marketers. Like give them more tools, give them more resources, let them keep doing what they do. Especially in like the first year or two, as I'm learning the business and kind of charting the course for exactly what we hope to become. One of the things as we got deeper in the business, we saw is that we've done a really good job at building out the executive ranks of our audience, and we are a daily read for the C-suite across the mortgage industry. But we were not as connected to the tip of the spear, the loan originators and the real estate agents. And that
when was that? Like, how long ago would you say? Because I feel like HousingWire does a good job at that now. Like, how long ago was that?
Yeah, we really started thinking about that tip of the spear concept in 2017. Okay. And then beginning of 2018 kicked off our strategy to better serve the loan originator and real estate agent.
That makes sense.
2018, we have some DNA as a kind of a newsletter driven business. Mm-hmm. And so we use newsletters to build communities and lists of people and engagement. And so we launched a newsletter called Lending Life specifically for loan originators in 2018. And that has rapidly grown. We're 20,000 plus bi-weekly subscribers on Lending Life now. And then beginning of 2019, we launched another newsletter called Open House specifically for real estate agents. So that was kind of our initial kick to like start better serving those communities. But we were really taking kind of a curation approach to looking at the content that we're already creating through our newsroom and like kind of figuring out, okay, this is really applicable for this job category. Loan originators need to know this or should know this. The same for agents. And what we've really tackled in the last 12 months is hearing more back from those audience segments, and then evolving our content strategy and adjusting our content strategy to better serve those audiences. So our DNA as an organization is a newsroom. We're not we're not like an evergreen house, like creating how-to content. We do a little bit of service journalism, but not a ton historically. But we know that to be the single sole destination for loan originators, we need to expand the type of content, the type of media that we're able to provide to our audience. And that's a big part of what's kind of kicked off this columnist or influencer strategy, as well as something that's really influenced our early steps into different forms of multimedia and starting to do more video, podcasts, different types of web presentations. So we're really trying to like go where our audience wants us to be, and serve them the way they want to be served. And a big part of that is mobile. And we see 65-70% of our audience on mobiles on some days. So that means we changed the way we serve audiences, and we did a massive website redesign and relaunch with a big focus on being more mobile friendly. And our chief product officer, Diego Sanchez, who sits here in this office in New York, he's got even more projects up his sleeve in the queue to continue our kind of shift to being more of a mobile first media organization.
I love it, man. It's staying fresh. I love the direction. I've seen the growth. It's actually, the stories intertwined with the RE source, because we started our show, 10 years ago as well. And it was actually pretty easy back then to create content, because news, even though it's only 10 years ago, but oddly enough, we could have like FHA could make a change and we could be first to get that out, because we still only come out once a week. It's difficult. Mad respect to you guys coming out hourly and every day. We only had to come up with something interesting that was 4 or 5 minutes once a week. So 2 or 3 things could happen in a week back then, and we would be first to market with that, with that story. And as HousingWire grew, it actually pushed us to be better, because it's like, I wanted to talk about that, but they've already pushed it out there, and then the second I want to talk, dang it, now it's out there, like everything we wanted to talk about, because, it's awesome. The information is so much faster now. So it's pushed us to get better as far as the content that we're creating. So it's really, I love it. We leverage it a lot, but it's pushed us over the years to get better, just because, of how we generate our content.
It brings us into interesting territory of how different types of media and different formats kind of play with news cycles differently. So we can be really quick with the written word. We can get a tip or have a change to FHA guidelines and be like live online in 15 minutes. It takes a couple hours to get set up for a podcast, maybe a couple of days to get host on screen or to get guest on screen for a video. So like we look at different media formats to serve different types of information and news to our audience. So we think about that a lot internally, and we actually have kind of evolved to a news team who's responsible for daily news. So they're cycling through everything that happens that day, from big changes in regulation to enforcement actions to people movers and big executive changes, like anything that's happening in the industry that's kind of on a tight timeline. We take a lot of pride and when we can, being news nowhere else and being first on a story. And we know we're the fastest on written word. Now, as we've matured, we also have a print magazine, which obviously runs an entirely different cycle. Like best case scenario, you're on a 30-day cycle. But reality, it takes about 30 days to prepare a book and then print it and then mail it. So like you're really like kind of operating like on a 60-day timeline. So magazine, not great for news content, but amazing for perspective and longer form journalism. Then everything in between is like I think what media organizations are figuring out today. So like podcasts give you the opportunity to see how several different news stories line up and identify themes and talk about the bigger picture. So you mentioned housing news earlier. That's what we try to accomplish there. We try to bring on an executive from the industry each week. As a news organization, we're covering the headlines, but for the most part, I mean, with a few exceptions on the team, we're not mortgage lenders. We're journalists.
Right.
So we want an executive from the industry, someone who actually runs money every day, to come on and say, all right, this is what this meant for me. This is what that meant for me. This is why these two things are correlated or associated. And so that's like a different content cycle. And video kind of fits in a similar territory. And then you throw live events in there, and it's another like longer form or cycle form of content. And that's what we're really trying to exercise our muscles on right now, is being really good on different types of content cycles. And we're really good at the daily, we're really good at the monthly, and now we're putting more resources into, all right, so how do we do stories that are going to take a couple of days of work, are going to count on talking to 3 or 4 sources or doing a survey or analysis. Like, that's the type of work that a lot of smaller media organizations just haven't dedicated the resources or bandwidth to get done. And that's a big part of where you'll see us spend time in the future. And we've launched a few new longer form articles this year in the last 2 weeks, and you're going to see a lot more of that as we kind of flex our muscles on different types of content cycles, so we can go deeper on analysis and perspective.
There's so many lessons to be learned for, again, originators and realtors, small business owners that are trying to build a brand, and just what you said. And I love that you're not ignoring any of the mediums, whether it's print, whether it's on the mobile, whether it's video, podcast. Like, there's a strategy for everything. And that's where I see a lot of, on the street level, realtors and lenders just get focused in on one revenue stream or one group of people. And it's like you realize there's so many other revenue streams that you could be running parallel. So awesome. I knew that was kind of the gold that I was going to be able to pull out, just knowing a little bit of the story. So I'm hoping realtors, lenders, small business owners are taking note. Let's switch gear. I'm kind of curious, kind of talk about the market in 2020. I know in your previous life, I believe you handled some mergers and acquisitions. And so for realtors, don't tune out. This is actually pretty interesting. But 2018 was kind of the talk of mergers and M&As. That's when profits were down, and I think the stat was we're losing $200 per loan type thing. 2019, obviously that didn't happen. And so it seemed like that M&A talk kind of quieted down. I'm curious your thoughts. Will we see that 2018 conversation come back into play into 2020? Like, I asked Garth Graham at Stratmore the same question, and I said, my remedial understanding is like, well, my stock just went up, so I'd like to sell it when it's doing well. And he wanted to give me a hug. He's like, Ryan, that's exactly right. But not all these CEOs really think like that. So I'm curious to your thoughts. Do you agree with Garth? Will the M&A talk go away, or profit's going to be plentiful and it's just going to be wine and roses from here on out?
There's a lot of different reasons M&A happens. Sometimes it's in distress, and that was the market condition we were talking about in 2018. People being forced into consolidation, needing that scale and a different balance sheet to continue operating was something that was a very real possibility for a lot of lenders who got really lucky in Q1 and Q2 2019 when the rate environment started to change. They were able to turn on that refi engine. It was that same period of time was also kind of peak kind of cost per loan on. I'm looking at my phone right now because I was at a conference yesterday. And Marina Walsh from the MBA was presenting her kind of updated 2020 forecast, and she shared some numbers. And I'm like kind of zooming into my phone right now, but I mean the peak cost to originate was Q4. Actually, it's just in Q4 2019. Yeah, well, she was saying it was $9,300, $9,299 to originate in Q4. They're projecting that cost to drop down to $72.17. So like close to a $2,000 cost per loan drop by mid 2020. So like that's a massive change in like the cost to originate and a massive change in the profit margin and financial profile of lenders. So we started with the distress scenario, and now we're moving into the scenario that you described and that Marina supported, where lenders are more profitable, P&Ls a little healthier, balance sheets a little healthier. Maybe if you're a refi shop, you're a little bit concerned about their projections on refi volume, which if I remember right from Marina's presentation, they're projecting that refi volume gets cut in half over the next 2 years, but while purchase grows. So that's kind of a healthy market condition. But if you're a refi shop, that could be a little bit scary, and maybe you're kind of seeing an opportunity to sell when your balance sheet or P&L's at a prettier place than it was 15, 18 months ago. I think I agree with Garth that people are going to be are going to take the Chuck Prince mindset. I remember back to my days at Citi, and when Chuck Prince, when he was CEO, said, I think it was keep dancing while the music plays.
Right.
And unfortunately, that seems to kind of be a condition we see in the mortgage world still today. People not like exiting it at top of market, but kind of wearing rose-colored glasses on what's to come. But I don't know if that's a terrible mindset, because it looks like we're going into a pretty prolonged period of housing economy health, and a lot of the conditions in the real estate world, especially when you look at the demand continuing to outstrip supply, probably supports very healthy home prices. I don't know if I'm going to say home price appreciation. We might start to see appreciation stutter out a little bit, but we have like this really good market condition that's supporting home prices. So we're not anticipating any like bubble-like scenarios on a national level. That might play out differently in certain regions. As we know, real estate is local, but at a national level, it feels it averages out to be pretty healthy. And we're also going into 2020 with a financing environment with low rates and plenty of access to credit and rising FICO scores and great employment. That supports household formation, that supports people purchasing their first home, and supports people upgrading and getting more square feet when it's appropriate. And that's might not be the worst time to be an operator in the mortgage industry or a loan originator or real estate agent.
All good news for originators, realtors. No, I don't want to jinx it, knock on wood, but those factors all look good. And that may tamper down any M&A activity that's out there, because they may say, hey, we're looking at a pretty good run here. Technology is difficult to adopt and invest into, so I could see those mid-level players struggling with that. I really like the takeaway from your podcast with Bill. It was really interesting because you asked him about kind of his plan, and he said, I loved what he said, because I'm a contrarian, so it seemed contrarian than what he said. I don't want to grow.
Yeah.
What? No, I don't want to add originators. I don't want to add volume, he said. But back to your point about lowering the cost to originate, he just wanted to figure out how to be more efficient. And I was like, that's brilliant. I love that, because everybody else is just like, grow. 10,000 originators, doesn't matter.
He described a really interesting business model, and he talked about the different legs of the stool he has. With
Smart.
Finance of America, like originations, fan business, their reverse business, fix and flip business, and all the services they also profit off of, how those pieces play together. And if you go into a flat origination market, or just focus on the highest margin or highest value loans, you can still see amazing EBITDA growth. So it's a really interesting strategy. It's not what I expected. What I expected to hear from Bill either, but
and he's always unfiltered too, so you get the truth, right? And you guys talked about how the housing is aging, and I love the opportunities. Looking forward, reverse mortgages, 203K rehab loans. It's all smart, getting ready for that opportunity that's going to be there, because people are staying in their homes longer. What do they need to do when their house is 50 years old? Rehab. Well, let's put that equity to you. And he talked about non-QM products, which we could nerd out on non-QM products for a long time. But it was a really good podcast. We'll throw it in the link in the comment section, because it's a high-level conversation that I think everybody can understand.
But one of the things that Bill talked about, and you mentioned as well, was technology, and kind of wrapping it up to like some of the headlines and things that are happening in the mortgage and housing world today. And also tying it back to some of the market conditions we saw in 2018, it's really hard to see return on investment from technology investments in low volume environments. So if volume is low, it scares people away from making big technology investments because they're just not going to see a return, especially an immediate return. So you think, all right, so the market changes and we have this like amazing 2019 with high with purchase and refi growth like higher than expected. Is that a good time to adopt or implement technology? Turned out to be equally challenging because all resources got kind of thrown at the origination channel. And dance while the music's playing. If there's a refi market to be had, like go after it.
Right.
And not necessarily the time that lenders can afford to allocate financial or human resources to implementing big technology programs or redesigning their origination process to be more efficient. So I think what we saw in 2019 was a lot of people had some trepidation about implementing a lot of those plans and strategies that they had been formulating over the last few years, and a lot of technology got delayed. So as we go into 2020, we look at like refis normalizing, purchase growing respectively. This could be an amazing time for lenders to like kind of take some of those resources and allocate them toward improving processes, improving their margin profile, and actually building much more profitable, efficient, longer lasting businesses. Yep. And that's what gets me excited. Now, if people can focus in the right places and say, all right, we had this amazing year, and we're going to take some of that profit and we're going to improve our process and help our people be more efficient and close more loans per originator and more loans per processor and underwriter and closer because we have these great tools. That's something that gives you staying power and really supports a healthy housing economy and a healthy employment market for the originators that we care so much about. So that's one of the things I'm getting kind of pumped about in 2020 is like, this is where the rubber meets the road. Are you going to invest in technology and improve your business? Or are we still going to just like push it off till next year? And if that happens, I'm just going to say those people they're never going to do it. And we'll wait for kind of the next crop of like innovative lenders to come around while the ones who are afraid to change or invest kind of age out.
Yeah, you highlighted an interesting kind of obvious dynamic that people haven't talked about enough yet, which is I think a lot of people had a lot of intention at the beginning of 2019 because 2018 was so difficult. So we want to focus on product and people and efficiencies. And they were all, again, just like anything, great intentions, but here comes this flood of business. So then what do you have to do? You have to concentrate on fulfillment. Oh, and then these ideas, these strategies that we wanted to, and we're kind of, necessity is the mother of invention. Like we were forced into getting these strategies, kind of got put on hold. I haven't really thought about that, but it's so right. Like everybody focused on just getting the gluttony of refi and purchase business through. Everybody had record years. So all those plans kind of got put on hold. And I'm guessing, to your point, that we may actually see some of these executed in 2020. Hopefully they should have, again, I agree with you, put it off another year, they got another problem.
Fulfillment. Resources went to fulfillment. And and instead of throwing process or technology at it, you throw bodies at it because it's faster. It gets you through that immediate need. When we announced Engage Talent, which we originally thought would be all about origination, how to retain, attract, and develop the best originators in the mortgage industry, we quickly got feedback like, hey, we love that, but we also need something on fulfillment and processing and underwriting and closing and post-close. We're like, okay, we'll do some sessions there for you as well. Yeah. But it was definitely kind of a sign of the times when we know that people are always focused on attracting and retaining the best originators out there. But you could very much tell in Q4 when we announced the Engage Talent that 50% of mind share was going to fulfillment, which is not kind of the standard mind share that we see in the mortgage industry.
Yeah, that's funny. I want to respect your time. We're going long already and I have a ton of questions. I'll ask you one more before we wrap up. Kind of a curveball. So whatever comes authentic, like just, the authentic answer, go ahead and just blurt it out. So we asked, I'm trying to remember, we asked Rob Krishman, Garth Graham, Bill Hart, Barry Habib, all one question, very similar, very same question to everybody. And I'll ask you, I'm curious of your thoughts. So we all asked them, what, in your opinion, do you think is the biggest challenge for both realtors and lenders in 2020? If you had to just think of one that comes to your head.
Focus on what drives your business. I think that's it. And I emphasize two things: focus in your I think there's a lot of noise out there of how some top originators or some top agents run their businesses. But I think every market and every agent, producer, originator has something different that helps make them successful, and be very realistic about what that one unique thing is that makes you successful, that you need in your specific market is. Like, that's where the focus has to be. So, I mean, if you spent your whole career originating loans, all off realtor business, and you have this amazing network that you've cultivated over 15 or 20 years, don't get too worried about the webinars that say you need to do 20 social posts a day and be on 10 different platforms and run retargeting ads to everybody within 5 miles of your office. Like, if you're doing all your business off realtor referral, yes, okay, market a little bit, but like hug that, like own it, like
lean into it.
And I think that's huge, and kind of vice versa. I mean, there's shops that are really good, kind of with more consumer direct strategy, and they're amazing marketers, and they're amazing on social, and they have these big local, regional, or national brands, and they may or may not be as reliant on like local market referral. Well, lean into the other side. Yeah. So I guess what I encourage is, going into 2020, something I have done, something I encourage all of our team members to do, is take a good hard look at what you're best at. It's actually one of the things I'm in New York doing right now. I just met with our chief product officer. We always have very real conversations about each other's strengths and where we can contribute most to our business. And then we go focus on those respective things. Yeah. And that's something I encourage everybody in the housing world to do as well. Take an internal look at yourself and not to steal like the book title or Marissa Meyer's quote, but like lean into that capability or that strength. That's what I ask people to do.
I love the variety of the plan too. I always say that, there's a million ways to make $1 million. And so just because all these top producers have a similar model doesn't mean it has to be yours. It would be wise to take, bits and pieces from them. Also, back to your point about what you're good at, because running a strategy that you hate, that's not fun. And usually doesn't yield results. So try to find strategies that you're good at. If you're good at video, lean into it, right? If you're good at the written word, lean into it. If you're good at, community, we call it community direct versus chasing the consumer direct online lead, great, lean into it. There's still a ton of business to be had, and everybody's freaking about consumer direct. Trust me, there's a ton of business at the community level. I'd love to see originators and realtors really commit and lean into that. Double down on that community strategy, man. I think as the world gets bigger, there's always, for every action, there's an equal opposite reaction. I think people tend to, a book I love called Small is Beautiful, start valuing the community versus it's so, it's so easy to connect to somebody across the pond, or everything's big, Amazon, blah, blah. I think people are going to kind of come back to that community person that they know and trust versus some person in a different state, different country. So double down on that strategy. I agree with you. Well, man, I've taken up much of your time. I appreciate it. We will post all the links in the comment section below. I'm sure Clayton's a busy guy, but if you have any questions, throw them down there, and I'm sure he'll answer them if he has time.
Yes, I'll certainly answer the questions, and hope that we see you and all of your listeners at our Engage Talent Summit in a few weeks. And,
absolutely. You have a promo code, don't you?
Absolutely. Since we talked about the podcast, we use the podcast code. So Housing News 2020 get you $100 off registration. And personally, really excited to see everybody in the Resource TV audience join us in Dallas in a few weeks.
Awesome, man. Thanks so much for your time. Appreciate it. See you guys next week.